So as you look at everything that's taking place, what's your current framework for the markets?
Buckle up. Tony, I've been doing this as some kind of chief investment officer since 1978, and this is about the wildest cocktail I've ever seen in terms of trying to figure out a roadmap. Just to frame things a little, the recession we had last year, or whatever you want to call it, the economic downturn, was 5x the average recession since World War II, but it did it in 25% of the time. More bizarrely, during the year, while 11 million people more were unemployed, we had the largest increase in personal income. We had the largest increase in personal income in 20 years during an economic downturn that's occurred. And of course, as you know, that's because of the massive policy response we got. The CARES Act added trillions of dollars in fiscal stimulus. How big was it? In 3 months, we increased the deficit more than if you took the last 5 recessions combined. And those were big ones. That was 73, 75, the 82 recession, the early 90s, the dot-com bust, and then, of course, the great financial crisis. If you added the increase in the deficit in all those 5 periods and combined them, we increased the deficit in the U.S. more in 3 months in 2020 than we did in that cumulative total. The Fed, in 6 weeks, bought more treasuries than they did in 10 years. The Fed, in 6 weeks, bought more treasuries than they did in 10 years under Bernanke and Yellen, when people like me were screaming about how excessive QE was during that period. Corporate borrowing, which almost always goes down in a recession as corporations re-liquefy, and had already gone from 6 trillion to 10 trillion because of free money going into the period, actually went up $400 billion. Just to put that in perspective, it went down $500 billion during the great financial crisis. So we had this massive increase in liquidity, this massive increase in stimulus, but so this is sort of the background, and obviously all this stimulus has flowed into financial markets, into commodities. Obviously all this stimulus has flowed into financial markets, into commodities, and financial interests. So it's sort of a bizarre background. The other thing I would say, I'm excited that we have an Asian audience today, because the juxtaposition of the various policy response is somewhat breathtaking. One of the best ways to encapsulate what I just talked about is, since 2018, M2 in the US has grown 25% more than nominal GDP. So we've had a 25% increase in liquidity. In China, M2 to nominal GDP is where it was 3 years ago. So they haven't borrowed anything from their future. We've had a massive liquidity input. And frankly, very little investment. It's primarily been transfer payments and Fed stimulus. And we've done a horrific job with the virus. The Chinese, basically Asia in general, the Chinese, the Taiwanese, Hong Kong, they pretty much defeated the virus. They haven't borrowed from their future. So the background could not be more different, but it also could not be more exciting if you're a macro investor, because on top of all this, there's the other big force in the equation, which is vaccines. And it's possible, in fact, probable, that all this stimulus is still going to be in place and frankly increasing just when we unleash the biggest increase in pent-up demand globally we've had maybe since the 1920s.